Matt, I thought you were going to say something. What's going on? I'm all by myself here. I am not all by myself here. I got my whole fantastic UWorld team in the background answering questions. We've got Chad, Mad, and Sam. Doesn't rhyme, but that's all we can go with. So guys, you want to say a quick hello? Sam, say hello.
And we have Rachel with us tonight also. So hello, everybody. Welcome to our webinar. First of all, we appreciate your time taking out of your Wednesday evening, and we think we're definitely going to be worth your while. If you've had any experience seeing Peter before, you'll know how dynamic he is, how smart he is, and I'm ready to go. Peter, are you ready to go?
I got to give you a big kiss for that, Sam. Hold on. Thank you, my friend. Oh my God, how kind is Sam to me? That's my boss. I'm looking for a big bonus this year, boy, oh boy. But hello, everybody. My name is Peter Olinto. I'm one of the lead instructors here at UWorld. It's a phenomenal team. We've got Darren DeGraff, Chris, we've got Sam, his entire team of subject matter experts. That's really the brain power behind this organization. As Sam mentioned, we do appreciate you joining us tonight. Obviously, it's a free event monetarily, but certainly not free in terms of your time. So we want to make sure we use your time wisely. We are going to cover ratios. I'm going to cover earnings per share, statement of cash flow, leases. So we'll do a nice blend of questions here. Just as an FYI, I am choosing questions for the most part that are on the higher end of the level of difficulty, math intensive, etc. I don't want to waste your valuable time giving you softball questions. On the back end, Sam's just gonna, say a quick word about the course. So if you're interested in joining us and enrolling in the course, that would be wonderful. So we have a QR code that you all can scan. I believe there's a thank you in the form of a discount for watching tonight. But with that being said, feel free, use your what is it, screen, you gotta take a screenshot, whatever it is, so you have your questions here. But yeah, let's jump in. I'm starting here with ratio analysis. So before I cover any questions, I want you to realize kind of our approach here at UWorld. We have pre-recorded lectures that walk you through the content. And look, we're going to teach it as though you haven't seen it before, although we're called a review course. The CFA is its own animal, because rarely do I meet anyone who says they majored in all these different topics, right? So macro, micro, global economics, all the financial statement analysis, corporate finance, equity, debt, forward futures, options, swaps, portfolio management, real estate, hedge funds, mutual funds. Oh my, I mean, there's quite a few things, not to mention the ethics. So look, it's there if you need it, right? It's insurance. But in addition to the pre-recorded lectures, we have live webinars where we do problem solving. We have, those are Saturday live online classes or on demand, where we actually work CFA Institute end of chapter questions and sometimes blue box examples. We like to incorporate that because a lot of times the detailed explanatory answers in the CFA Institute readings are just not as robust as they could be. Plus, every question is an opportunity to review the topic in greater detail, which is what we do. And on top of that, the CFA Institute authors are brilliant. There's just no ifs, ands, or buts. But there's really no attempt to collaborate. So it looks like, especially at level 1, it looks like a lot of disjointed topics, but it's really not. I mean, the econ, the accounting, the quant, I forgot to mention earlier, those are the tools that we'll use in corporate finance, equity, debt, portfolio management, derivatives. So when you see the overlap in the topics, all of a sudden it becomes much more manageable. So we take the time, like if I'm working a class in fixed income, I'll mention, hey, we're going to use these, these spot rates or these forward rates. Again, we'll see that in derivatives, whatever it may be. Or maybe we learned a formula in quant, the Sharpe ratio, or capital asset pricing model, whatever it may be, correlation coefficient, covariance. We'll see that again in portfolio management. So I think the course does a great job in going back and forth and cross-referencing so that you can absorb this information. While it is math intensive, 2/3 of the questions exam day, ironically, you won't even be picking up your calculator because they want to make sure you understand the concept rather than just memorizing a formula, right? So yeah, this is going to give you a good feel for at least the accounting end of it. The vast majority of our students are not accounting majors. My background is a US CPA. went on and got my law degree, and then I passed all 3 levels of the CFA. And so what I really am is a professional test taker, but I will make you feel really good, because if we had a 2-tailed distribution of the IQs on this call, now this is the average IQ, you know where my IQ is? In the left tail. But I've never failed any test I've ever sat for, which means you all should be getting perfect scores. So while my IQ might be in the left tail, you know what's in the right tail? My work ethic. And that's the difference between success and failure, okay? It's putting the time in to really understand the concepts. And before we work the questions, you know, level 1 is the foundation for the quant, the accounting, equity, debt, derivatives, and portfolio management that you'll see again in level 2. And then every one of those topics you'll see again in level 3 other than the accounting. So the goal is not to barely pass level 1. The goal is to kick ass in level 1 so that you have a good foundation so you have no problem getting through levels 2 and 3. People tend to get stuck more at level 2 than level 3 because they don't have a really good foundation in the quant, in the equity, in the debt, in the portfolio management, the accounting, etc. So they struggle at level 2, right? So let's make a concerted effort to really enjoy this. It's actually kind of fun, I think. So ratios, they go in different buckets. What are ratios going to help us do? Well, assess risk. Risk is important when assessing what? Required rate of return. Think about everything in the level 1 curriculum is boiling down to, hey, I want to figure out the rational value of an asset. The value of an asset is driven by the future cash flows, which could be in the form of dividends, interest, rent, maturity value, proceeds on sale. But we want to use ratios in particular to determine some of the inputs to our valuation models. So we want to forecast future cash flows or future earnings or what we call value added residual income. But those future cash flows have to be discounted back to today. The discount rate we choose has to be compensation for all risk assumed. The accounting really helps us understand financial risk. There's short-term financial risk. There's long-term financial risk. Short-term liquidity, can you pay your debts as they become due? Long-term solvency, how did you raise your capital? A lot of overlap with corporate finance. What combination of debt and equity? So looking at your capital structure, okay, that's our hurdle rate for success as well. Your weighted average cost of capital. But we want to understand financial risk as well as operating risk. So the operating risk, can you generate cash from your core business? And is it stable or is it volatile? So what's your standard deviation in sales, standard deviation in EBIT? Okay, we want to look at ratios to help us also assess performance, your margins, your profit margins. We also want to look at returns, maybe the return on your asset, the return on your equity, okay, etc. So the ratios are going to be helping us, you know, using the financial statements again to determine the inputs to the models. And then we also want to determine, hey, is there an opportunity for growth? Growth helps to mitigate risk. The higher your growth rate, the higher the value. The higher your future cash flows, the higher the value. The less risk of achieving those future cash flows, both in terms of amount and timing, the higher the value, okay? So a lot of these ratios, again, will be used elsewhere in the level 1 curriculum. But we start off with, hey, which of these is least accurate? So we don't want to make a silly mistake. We're looking for a false statement. Ratios cannot be used in isolation. That's a true statement. That's an incorrect choice. You want to look at ratios holistically. Okay, just because a company has a very high current ratio, that does not mean there's no risk of financial distress. They might have a high current ratio because they have a lot of inventory in those current assets that they can't sell. And because they can't sell it, they have a lot of current assets, but that doesn't mean that they don't have risk of distress. So they might have receivables that are not collectible, okay? So you can't look at things in isolation. Just because a company has a low current ratio does not mean they are in risk of financial distress. They might be very profitable. They might have easy access to a line of credit. All right, so we want to look at things holistically. Ratios are not affected by a different accounting treatments. That is the correct answer. That is the false statement. You bet. They are affected by methods of accounting for things like inventory, depreciation, estimates, salvage value, useful life, your accrual for bad debts, expected credit losses. Okay, there's lots of things that drive the numbers on the financials. Companies can use methods that are relatively conservative or aggressive. That affects quality of earnings. Statement of cash flow is going to help us determine quality of earnings. We'll see that tonight when we look at operating cash flow relative to the accrual basis net income. Well, if the accrual basis net income is growing period after period, but I don't ever see the cash being generated, very low quality of earnings. I don't believe those accrual basis earnings, okay? Ratios are useful. We need something to compare it to, cross-sectional, comparing to the peers, the industry standard, or maybe trend analysis, looking at the company relative to itself over time. All righty, one question down, 4 million to go. One of the things I'd like you all to do, you ready? Get familiar with how to read questions, okay? Before you read the facts, it's usually very helpful to look at, well, what are they asking me to do with those facts? So they want me to do inventory turnover, receivables turnover. What I would do if I were taking the exam is, hey, before I read any facts, what are my formulas? Oh yeah, inventory turnover, cost of goods sold divided by average inventory. I want to see that inventory coming off my balance sheet and being sold. I'm not saying I want to pay a lot for my inventory. I'm saying I want a lot of activity. I want that inventory coming off the balance sheet. I want to have high turnover. High turnover in the abstract doesn't mean that much, but folks, when you take 365 and you divide it by your turnover, that tells you the average number of days it takes you to sell that inventory. All right, so you write your formula down. Receivables turnover, net sales divided by average receivables. Why average? Anytime you mix income statement with balance sheet, if possible, the balance sheet number should be an average. Why? Because the balance sheet is different than the statement of cash flow and the income statement in that the balance sheet is cumulative. So you really can't use the beginning of the year or the end of the year. Since the income is produced throughout the year, the cash flow is generated throughout the year, it's better to use the average balance sheet number. Okay, so I want those receivables coming off my books. I want to have a lot of sales. I want my turnover to be high. If I have higher turnover, 365 divided by a higher accounts receivable turnover, that means, hey, it's not taking me all that long to collect. My number of days to collect goes down. Those two numbers added together get you a very important subtotal. Number of days to sell plus your number of days to collect. I want to sell quickly, but I don't want to give it away. I want to collect quickly, but I want to make sure I extend fair credit terms so I don't upset my customers. That's it. Gets you a subtotal called the operating cycle. You would like your operating cycle to be less than or equal to the industry standard. This is many times driven by the credit terms. Like, you ever see those commercials? No credit, no problem. Yeah, they extend credit to anybody who walks in the door to buy a car. They can sell the car, so they sell quickly. Problem is they can't collect because they never did a credit check. On the flip side, you might have a really strict credit policy. Well, that means you'll have no problem collecting because you're not going to extend credit to somebody unless they're credit worthy. The problem is, though, you're not going to have a lot of sales if you require, credit score above 800, right? So we want to have a mix. We want to have the right blend with selling quickly, collecting quickly. So the optimal credit policy is the one that reduces this thing called the operating cycle. Okay. So a company's employed a new financial controller who has installed a new system to improve the efficiency of inventory. So folks, they're not going to make it unless there's demand for it. This is called a pull approach, okay? A demand approach, a just-in-time approach. I don't want to make it and have surplus inventory that could become obsolete or sitting around somewhere that I got to store that's going to raise your storage costs. So look, I'm not going to make it unless I know somebody wants it. So I'm going to reduce my carrying of inventory. I want to just have enough to meet the demand. If I can minimize my inventory, I can maximize my turnover. So my inventory turnover is going to do what? Increase. All right. They also tell me we've written off a large amount of accounts receivable. This is why ratios could be dangerous when people don't really understand what they're doing. On the one hand, when you write off accounts receivable, Well, accounts receivable is going to go down, but you did not collect the cash, mind you. You wrote it off. Nonetheless, mathematically, you're going to have lower receivables. You're going to have higher turnover. That's going to increase as well, but that's not good news. We're not in the business of writing off receivables. We want to collect it. We don't want to write it off, okay? So that's why it's very important you don't look at any ratio in isolation, right? Holistic approach. You want to make sure you're collecting and you're not writing it off. Okay, 2 questions down. Oh, by the way, there's one other piece of this puzzle here. When you take your operating cycle, when you take the number of days to repay your vendor, number of days to pay your vendor, that gets you what's called the net operating cycle, which we'll see later, also known as the cash conversion cycle. This is how long it takes you to generate cash from your core business. The more quickly you can generate cash from your core business, well, that means the more successful you are, right? Higher value, less risk of distress if you could generate a lot of cash that you could use to pay your bills. That'll also reduce your cost of capital because I'm not going to have to borrow to raise capital to finance growth, nor do I need to add partners, which will dilute my earnings per share. Okay, so we love to see cash being generated from our core business. You know what's interesting about the number of days to pay the vendor? You want to stretch it out. You never want to incur fines or penalties. That goes without saying. But if you're given a 60-day grace period, take the full 60 days. Why would you pay back early? Let your money stay in the bank or invested, earning interest for you. The only time you'd want to pay quickly, remember that stuff, financial accounting? If you ever took a financial accounting class, 210 net 30, if they offer you the opportunity to take a 2% discount, for example, if you pay in 10 days, you better take that discount because the opportunity cost of not taking advantage of that discount is very high. And you'll see that in corporate finance. All right, beautiful stuff. Let's see what we got. We got all these numbers. What the hell are we going to do with all these numbers? Legalized cheating. We go to the question stem. They want to know, hey, what's your payables turnover ratio? Okay, assuming there's no change in inventory levels over the year, ABC Corporation, their payables turnover is what amount? So again, the first thing I want to do, I want to take a look at my formula, and I'm going to put it up here for you. Okay, so my payables turnover, there's kind of 2 ways you could do your payables turnover. You could take cost of goods sold divided by average accounts payable. If you have the detail, you could take purchases, which I'll talk about later. Divide that by your average accounts payable. So there's 2 ways of doing it depending upon the given information. Okay, to find your purchases, you'd have to have a lot of detailed information. Like you'd have to have beginning inventory plus your purchases. That gives you everything you have available for sale. Back out your ending inventory, therein lies your cost of goods sold. Beginning inventory you'll see on last year's balance sheet. Cost of goods sold you'll see on the income statement. Ending inventory you'll see on this year's balance sheet. So if you have all this detail, you could back into purchases. It really depends upon how close the answer choices are. They're so far apart that we could just estimate. It'll be so much easier to just use cost of goods sold. Okay, your answer choices are far enough apart, cost of goods sold will be fine. So they tell me my cost of goods sold is 75. We got one piece of the puzzle. My accounts payable, well, let's see. They did not give me beginning and ending information. We don't have a lot of detail. We can't take an average. You only have 1 year's worth of information. So we'll just use our current accounts payable. So 75 divided by 30, 2.5, 2.5. Okay, there's our payables turnover. All righty. So 2 down, 3 down, lots and lots to go. Let's try our next one. Again, lots of given information. Don't know what to do with any of those numbers. So we go to our question stem. We write down our formula. Let me put it here so I could cherry pick. All right. Inventory turnover. Sorry about that, folks. Cost of goods sold divided by average inventory. Cost of goods sold divided by average inventory. Therein lies your inventory turnover. If they give you 2 years worth of information, folks, you got to use it. If they only give you 1 year's worth of information, then an average is not necessary. Okay, so I don't have 2 years worth of information. All I have, oh, and by the way, it is an average. Okay, cool. So the balance sheet numbers, they've already provided us an average. Wonderful. Okay, so my cost of goods sold, 75. My inventory number, 70. 75 divided by 70, what's my inventory? Turnover, 1.07. Now, is that good or bad? It doesn't sound all that good, but it's all relative to what? Prior years, and or if you have an industry standard. Ratios, again, in a vacuum, vary dramatically from one industry to the next. So we really want to see, as a general rule of thumb, you know what inventory turnover would tell you a lot about? Are we selling like luxury goods that cost a lot of money, or are we selling like pencils? Like, there's two ways of making money, right? Your return on your asset, your return on your investment, how much profit you make on every sale, and how often you turn over your inventory. As a general rule of thumb, when you have lower turnover, you're selling $1 million yachts, $500 million, whatever. You're probably going to have relatively low turnover, but when you do sell one of those yachts, yeah, you're going to have a high amount of profit. Pencils, on the other hand, you're not making a lot of money every time you sell a pencil. So you better sell a hell of a lot of them, right? So we could get a picture of the industry we're in, but it does vary. So that's why we always want to compare to the specific industry standard. Okay. Next question. Return on equity, heavily tested, folks. Return on equity is part of a bigger puzzle. You see, I want to use the company's return on equity, multiply that by 1 minus my payout rate, because that's going to get me my growth rate. And my growth rate, as we saw before, your future cash flows, discount rate minus growth, that's one way of getting your rational, your fundamental, your intrinsic value. Okay, so growth is driven by your return on equity. The higher your return on equity, the higher your growth. Okay, it's also driven, 1 minus the payout is also known as your retention rate. If you have a lower payout rate, you're going to have a higher retention rate. How do you get your payout rate? Dividend per common share divided by your earnings per share. But it's earnings per common share, okay? Dividends per common share. That's one way to get your payout. Or you could look at dividends, common stock dividends declared, divided by net income minus preferred dividends. That denominator is also known as income available to common stockholders. So you've got two ways to get that payout rate. The dividend declared, you can find on a company's statement of retained earnings. And remember, this is all common stock, earnings per common share, dividends per common share. All righty. Now the question becomes, how do we get return on equity? Well, the simplest way to do it is to take your net income divided by your average equity. Okay. So that doesn't tell you a lot, though, in terms of what's driving your return on equity. You know what's interesting, though? Let's say a company has a very high return on equity. They don't have a lot of partners. When you look at the company's debt to equity, they don't have a lot of equity. They borrowed a lot of their money. The good news is, yeah, you don't have a lot of partners. You can expect a higher return, but your degree of financial leverage is higher. You're assuming more financial risk in the way you raise your capital, because you got to find a way to pay that interest as it becomes due. On the flip side, if you've got a lot of equity and you've got a lower return on equity, chances are when you look at their capital structure, higher equity, lower debt to equity, granted you're getting a lower return, but you're also assuming less risk. Why? Because common stockholders are promised nothing. There's nothing legally required to be paid to them on a regular basis. Okay, unlike debt, there's no maturity for equity, right? Debt has to be repaid at a certain period of time. Also on debt, interest bearing. At some point, you got to pay interest on that as well. With dividends, common stock, no dividends are required. And with equity, it doesn't mature. So it completely mitigates the risk of distress, but a lot of partners, lower return. Okay, another thing we could do is look at the DuPont model. Net income divided by your sales divided by your average assets. This gets you your return on your asset. Profit margin is heavily dependent upon levels of competition. Turnover is heavily dependent upon management efficiency. if you're running an airline, you don't want to have airplanes sitting around not flying passengers. You have to make sure you're making good productive use. You got to have the right amount. If you're Starbucks, how many stores should you open? How many stores should you have, right? So you don't want to have too few, you're going to lose demand, but you don't want to have too many, because then you're not going to get a return that justifies the cost of that asset, okay? So return on asset. You can then take your return on asset, compound that with what's called your degree of financial leverage. This is your amplifier. This amplifies the risk assumed as well as the return to the stockholders, the common stockholders. So when you have a high, there's two ways of getting your degree of financial leverage. You could take your asset divided by your equity, or 1 plus your debt divided by your equity. And all the balance sheet numbers should be an average if possible. Okay, so when you don't have a lot of equity, but you have a lot of assets, when you don't have a lot of equity, that means you borrowed a lot of money. The higher your degree of financial leverage, well, that amplifies the risk assumed as well as your potential return. So that's another way to get your return on equity. Okay. Now, how you're going to solve for this is dependent upon the facts. Sometimes they will give you, and let me just stick it here. Sometimes they'll give you even more detail. Sometimes rather than giving you a profit margin, it's called the 5-stage DuPont model. What they'll do is give you the company's operating margin, heavily dependent upon, again, competition, how much money you have to spend on marketing, advertising. Okay, can you raise your selling prices? What's the demand for your product? What's the elasticity of demand? Economics comes in. Okay, power, who has the bargaining power? The suppliers. You don't like it when your suppliers have bargaining power. They could raise their prices. You want to have the power. Okay, then there's something called the interest burden, earnings before tax divided by EBIT. It's actually counterintuitive. While they call it a burden, it's really a retention rate after you cover your interest burden. EBIT stands for earnings before interest and taxes. You want to have a high operating margin and you want to retain a lot of your income after you've covered your interest burden. Lastly, we could break this into our third component, our tax retention rate. Earnings before tax, our net income divided by our earnings before tax. How much income, again, they call it a burden, but it's really the retention rate, what you're retaining after you cover your burden. So the higher, the better. Okay, how much of your net income are you retaining after you cover that tax burden? That's heavily dependent upon political factors. Okay, what are they doing with the corporate tax rate? Your interest burden, your level of debt, and your cost of borrowing. Okay, the more debt you have at a higher cost, the higher your interest burden, the lower the retention rate. Okay, so now with that review, let's see, how are we going to find return on equity? I would love to just take my net income divided by my equity, but I do not see net income here. I don't. But I do see my net profit margin, beautiful. I got one piece of the puzzle. My profit margin, 3%. I see asset turnover right there, 1.5. Okay, so now we have two pieces of the puzzle. Okay, that'll get you your return on your asset. Okay, so our return on our asset, 3% times the 1.5, we got 4.5%. Okay, the only thing we're missing is our degree of financial leverage, and they gave it to us, 1.8. 4.5% times 1.8, 8.1%. Therein lies our return on equity. So we used the 3-stage DuPont model, profit margin times turnover. You didn't need this subtotal. You could have just done profit margin times turnover times degree of financial leverage. That's fine. You didn't need a subtotal, but your profit margin again, 3%, turnover 1.5, degree of financial leverage 1.8. There's our return on equity. All righty. So formula first, then we cherry pick the information. I'm obviously explaining as I go along, but the key point you should be learning technique-wise is before you rush to the facts, what's the formula? Then you work backwards and plug it in. Okay, let's try another one. They tell me how do you explain? Now look at this. It's not just about crunching numbers, right? Now it's about explaining. Okay, how do you explain these numbers? Well, we got trend analysis. We're looking at year one last year versus the current year. So we're doing a little trend analysis. All right, let's see what happened. Return on equity went up. That's good news. Yet my return on total assets went down. How the hell is that possible? Well, total asset turnover, whoa, information overload. Let me set it up. Net income divided by sales, my profit margin. My sales divided by my assets, my turnover. My degree of financial leverage, my asset divided by my equity. There's my degree of financial leverage. There's my return on equity. Or if you take your net income divided by your sales, times your sales divided by your assets, there's your return on your asset. Combine that with your degree of financial leverage, therein lies your return on equity. All right, so what did they tell me here? First of all, the good news is return on equity is up. That we know for sure, right? Return on equity is up, but we kind of have like conflicting information. My return on assets is down while my total asset turnover is up. Okay, so my asset turnover is up. Well, how could your return on assets be down if your asset turnover is up? Well, we can then infer profit margin has to be in what direction? Down. Okay, with a higher turnover, yet a lower return on asset, we have to have a lower profit margin. So my profit margin decreased. Look at that. We didn't even need to solve for financial leverage, but we're going to do it anyway. How is it that financial leverage increased? Well, your return on asset decreased, yet your return on equity increased. It improved. Well, it's not due. This is the beauty of the DuPont model. It's explaining what's driving that return on equity. Folks, we must have a higher degree of financial leverage. It had to increase. The only way you could have a higher return on equity, yet your return on asset is lower, it went from 4.5 down to 4.2, we must have more borrowing. That's not a good thing. Okay, that's not sustainable. If your return on assets keep declining, who's going to lend you money? And if they do lend you money, it's going to be at a much higher rate. So at some point, that's going to work against you, okay? Because it'll so negatively affect your profit margin if your cost of borrowing goes up. All righty, so that's the beauty of the DuPont model. Explains why things are happening. Okay, let's try another one. They tell us if a manufacturing company has a very low total asset turnover. First of all, when you're a manufacturing company, capital intensive, they have a lot of PP&E, right? So if you're manufacturing products, your fixed assets, your PP&E tend to be high. All right, so how do we get asset turnover? Net sales divided by average assets. All right, so we know that our turnover is low. So what can we infer? Our assets are probably higher and or our sales are lower. Okay, so some combination therein. We either have more assets or we have lower sales, but something is causing our turnover to be lower as compared to the competitors. That's called cross-sectional analysis. Could it be because the company is using older and in many cases fully depreciated machinery? No, if anything, it's not older, it's probably newer. If it's newer, the book value of the asset would be higher. The accumulated depreciation would be lower, meaning the book value of the asset would be higher. And if you bought it recently, if it's newer, chances are in an inflationary environment, you paid more for it than people did years ago. So I'm not liking the first choice. The company has too much capital invested in assets for the size of its revenue. That might be it. They might have too many stores, too many factories. All right, that could be, that's a could be for sure. But let's check C. The company uses operating leases rather than outright purchasing of machinery. Today, when it's a lease, whether it's what we call an operating lease or what we call a financing or a capital lease, US GAAP, NIFRS, as a general rule, anytime we have leases, that's going to make your assets go up, your liabilities go up. The present value of that lease obligation, which I'll show you later, You've got to book that asset as if you bought it. Take the present value of your future lease payments, discount it back to today. That's your make-believe purchase price. It's as if you bought it with borrowed funds. So that would cause our assets to be higher rather than lower, okay? So the company's using, or this, no, whether they use operating, they'd have operating leases rather than the outright purchase. No, it would have the same effect. So this is definitely wrong. Same effect. Okay, whether you buy it or you lease it, either way, the book value of the asset. So whether you purchase it, whether you borrow and buy, or you lease it, either way, your assets are going to be higher. So there's no difference between those two. So that can't be the answer. So in fact, the correct answer is B. They must have too many factories, too many stores, okay, given the size of its sales. Okay, let's try another one. Again, start with your question stem. Your return on your invested capital. Okay, first of all, the goal of every company is to get a return on invested capital that is greater than their cost of capital. That will cause their value to go up. Okay, that's called economic value added, when you could get a return on your invested capital greater than your cost of capital. There's two ways of getting capital. Total capital is not the same thing as total assets. So when you look at a balance sheet, here are your total assets, the sum of your debt and your equity. Total capital is not the same thing as your total assets. Okay, if you took your total assets and you backed out your non-interest bearing debt, your operating liabilities, non-interest bearing debt, that's one way to get total capital. Or if you added up your short-term debt, your long-term debt, the key is both of these are interest bearing. Whether it's long-term or short-term, it's interest bearing. If it's interest bearing, you're going to learn tonight that's a financing liability. Okay, that is part of your capital. If you take your short-term debt, your long-term debt, and all of your equity, that is total capital. Okay, operating liabilities are non-interest bearing. They're accruals. You book the liability because you've already booked an expense and you haven't paid the bill yet. That's not negotiated debt. Negotiated debt is when you go to a bank or you issue bonds or debentures or you get a mortgage or a line of credit. Interest-bearing debt, that's raising capital, okay? So total capital. Now, how do you get return on invested capital? You ready? NOPAT divided by your total capital. If possible, it would be average total capital, if possible. What is NOPAT? The company's operating income, EBIT, times 1 minus the tax rate. Your operating income, your EBIT, your earnings before your interest and taxes, times 1 minus the tax rate. That's your net operating profit after tax. Remember, you got to share with the government. Okay, and remember, we're looking at return on invested capital. Some of that return goes to the creditors, some of it goes to the preferred and common stockholders. Okay, so we want the earnings before the interest, but after the tax. That's called NOPAT. So NOPAT divided by our average total capital. So now that I've got my formula, let me take a look at my given information. Okay, they tell me we've got our income statement again, balance sheet is already an average. All right, accounts payable is an example of an operating liability. Short-term banknotes, you pay interest, long-term debt. When you see the words note, debt, bond, debenture, mortgage, line of credit, those are financing liabilities, interest-bearing debt. Those two added together are 85. My equity, all equity, common stock, retained earnings, all your equity, preferred equity as well. That happens to be 0, but I'm going to put it in just so you know it's part of this. Add that up, 165. There's your total equity. So my total capital is the sum of the two, 250. Or you could take your total assets. If you took your total assets, total liabilities, by the way, and equity have to equal your total assets, right? They got to be one and the same. If you took that 280, backed out your operating liabilities, same result, different format, total capital, 250. All right, so my NOPAT divided by my total capital. Total capital is 250. Now I might need my EBIT, my operating profit, my earnings before my interest and tax. Okay, so my operating profit is 55. That is your EBIT. Okay, so now what is my tax? You ready? My tax is 10. So we want to take that 55. We want to back out the 10. Okay, so let's do this. EBIT minus your tax expense. There's your T. Okay, or I should say EBIT minus your interest. There's your earnings before tax. Okay, what is my tax? My tax is 10. So 40 minus 10, there's your net income, 30. All right, so operating profit 55, your EBIT, minus your interest expense, that's your earnings before tax, 40 minus 10, net income 30. Now, I want to find my what's called my effective rate of tax. Your effective rate of tax is what you see on an income statement. So my NOPAT, EBIT times 1 minus the tax rate. So what is my effective tax rate per this income statement? Well, we know our tax expense is 10, and we know our earnings before tax is 40. We calculated that for ourselves. Okay, we got that subtotal. So what's my effective rate of tax? 25%. So NOPAT is really EBIT times 1 minus the tax rate. It's the percentage you put in your pocket. All right, so if you're giving the government 25% of the money, how much are you putting in your pocket? 75%. So let's take our operating profit, 55. Let's multiply that by 1 minus the tax rate. So you're putting 75% of that 55 in your pocket. You're putting 41.25 in your pocket. Net operating profit after tax divided by that total capital. What do we got? 16.5%. That is your return on invested capital. Okay, 16.5. So that's another common ratio assessing performance. Okay, so your profit margins, your turnover, your return on asset, return on equity, you're looking at your performance. Okay, now we have overlap with equity analysis, using multiples to try to figure out, is a company a good buy? Is it something we want to pursue? So price divided by your earnings per share, your price in the market. How do we get that earnings per share? Your net income minus your preferred dividends. Okay, divide that by your number of common shares outstanding. Now, logically, I'd want to have a lot of net income, a lot of income available to common stockholders, right? We want a high amount of income available to common stockholders. And if the news is good, I don't want a lot of partners. So I'd rather have a higher EPS. What does it mean when you have a relatively low PE? You can't jump to the conclusion immediately that this company's a good buy. That's a common mistake. When a company has a relatively low price to earnings, there are multiple reasons why you might have a low PE. Maybe you're trading at a lower multiple because you have higher financial risk. Your balance sheet, you've got a ton of debt. Or maybe you're trading at a lower multiple because you have a lower growth rate. You can't justify a higher multiple because for whatever reason, you have a lower growth rate. Okay, maybe it's due to low quality of earnings. Maybe you have a low quality of earnings. That means when you have a low quality of earnings, when we looked at net income versus cash flow from operations, I see the net income going up and up, but I don't see the cash being generated by the core business. Okay, it could be due to low quality of earnings. Net income can be manipulated, folks, okay, by methods of accounting and estimates. Choosing, let's say, FIFO rather than LIFO in the US, or maybe using straight line when everybody else is using accelerated. You might have a higher net income because the company is choosing estimates that reduce the expense or increase the revenue. All righty. If none of those are true, then you know what the default is? If none of those are true, they don't have higher financial risk, They have similar growth as everybody else, and you could use something called the PEG ratio that we'll see later on. They don't have lower quality of earnings. They're using pretty much the same methods and estimates. Once you factor all of those other things out, then you could say, you know what? I think they're relatively undervalued. I think they are a good buy. But before you jump to conclusions with multiples, especially price to earnings or price to book value, the income statement and the balance sheet are susceptible to management manipulation. And I'm not necessarily talking about committing fraud, although they could, but they can manipulate earnings in such a way that they choose methods and estimates that are lawful, yet give them lower quality of earnings, okay, relative to the peers or whatever else. All right, let's try another one. See what else we got. Okay, so again, a lot of numbers here. Let's get to the question stem, see what they want us to do. Wow, that's a lot of information. Seems very overwhelming. Let's see. They want to know Magma Corporation's liquidity position, short-term risk of distress. Folks, so what kind of ratios do we look at when we're assessing the short-term risk of financial distress, the inability to pay our debts as they become due? Well, the ratios we generally look at, the current ratio, we could look at something called the quick ratio, the cash ratio, and something called a defensive interval, how long the company can last without generating any new cash, okay? So there's different ways we can assess risk. Liquidity is short-term risk of distress, okay? So while there's a ton of information here, we're primarily focusing in on those ratios. Now I look at my choices. They want to know, has it improved? Has it worsened? Has it remained the same as measured by what? The current ratio. All right, so let's see where we are prior year versus the current year. So I need my balance sheet information. Oh, wrong direction. I need my balance sheet information. All righty, so there's our income statement, balance sheet. We need our balance sheet. Okay, so as soon as I see my balance sheet, 2008 is the prior year, current year. Current assets divided by current liabilities. The more current assets you have, the less current liabilities. It's a coverage ratio. Coverage, how much do you have in the numerator to cover your obligations that are coming due within the year? As the coverage ratio goes up, risk is going down. So I need to do prior year versus the current year and see what the trend is. Is it getting higher or lower? All righty, so prior year, current assets, here we go, my current assets. So let's add up all of our current assets. Let's see, total current assets. Oh, sorry about that, folks. Total current, oh, that's not our number. Total current assets. And then I need my current liabilities. Where are my current liabilities? Well, I see my current assets. Where would my current liabilities be? Let's see, long-term debt. There we go. All right, current year, prior year. I got that. See, I'm dyslexic. Prior year, current year. The first column could be the prior or the current. Okay, it depends where you are around the world. Current assets, prior year, current year. All right, so now let's plug in our numbers, dropping the zeros so we can move more quickly. Prior year, 26.6 divided by 8.5, 3.13. Current year, current assets, 31.6, 12.3, 2.57. It went down. It went down, folks, 2.57. So it's worse, okay? It's relatively speaking, it's worse. It's gotten worse. Now, is 2.57 bad? You know, I don't know. What's the industry standard? So we might, relative to ourselves, be a little bit riskier. But if nonetheless, the standard in the industry is 2.5, we're still better than the standard. But I don't know that, but I'm just saying, okay? So it looks like it's worsened, okay? Because the current ratio went down. Now, another thing to note, when you have a high current asset and you don't have a lot of current liabilities, we just said your risk is lower, but chances are, you know what's lower as well? Return on assets. Because if your current assets are made up of a lot of cash, marketable securities, accounts receivable, inventory, prepaids, the return on short-term assets is generally lower than the return on longer-term assets where you assume more risk, you buy more PP&E, maybe you have more intangibles, maybe you have more PP&E, long-term investments in other companies, stocks and bonds in other companies versus short-term marketable securities. What kind of return do you get with short-term marketable securities? Highly liquid, not much. All righty. So remember, no free lunch. If you have a relatively low current asset, higher current liability, yes, you're assuming more risk, but that might be justified, maybe, given the return. Okay, so that's part of portfolio management, quant ethics. You got to talk to your client about the pros and cons and educate them. There's no such thing as a free lunch. Rarely do you assume low risk and get a high return, right? So we got to educate our clients. All right, let's see. Let's try another one of these. They want us to, what is the company's ending inventory? So it looks like we got to back into ending inventory. So what kind of information did they give us? Payables turnover, average trade payable, all that kind of good stuff. So I'm thinking, okay, how are we going to back into ending inventory? I showed you a formula earlier that's important that you got to know both for ratios and inventory analysis. Beginning inventory plus everything you purchase gives you what's called cost of all goods available for sale. Back out what you did not sell, ending inventory, that tells you what you did sell. We're looking to back into that number right there. Okay, so what pieces of the puzzle did they give me? Cost of goods sold, 74, drop the zeros. Let's see, opening inventory, beginning inventory, 32. All right, so we got another piece of the puzzle. Purchases, I don't see purchases, but remember I said to you earlier, there's a couple of different ways of getting payables turnover. Remember I mentioned that? Rather than putting cost of goods sold, we could put purchases, divide that by average accounts payable, and that'll get you accounts payable turnover. 365 divided by accounts payable turnover, that tells you the number of days on average to repay your vendor. Okay, let's see if we can't back into purchases. Well, they tell me my payables are turning over how many times? 8 times. So we have that piece of the puzzle. What's my average trade payables is the same thing as accounts payable, 11, dropping the zero. So my numerator then's got to be 11 times 8. That's got to be 88. Okay, so now I got my purchases, 88. 88 plus 32, how much is everything we had available for sale? 120. Well, if you sold 74 out of the 120, then how much didn't you sell? Boom, there it is. As my good friend Sam says, who's better than you? Sam, who's better than you, by the way?
I keep looking for that, Pete, and but you know what? I will freely admit that you are. You are.
Absolutely impossible. We know the answer to that question. It's nobody's better than Sam. All right.
You are so kind.
So folks, connecting the dots. They love when you have to manipulate and find missing pieces of the puzzle. Like, with a balance sheet, you got assets minus your liabilities. There's your total equity. Your equity is made up of different sources of equity. You might have common equity. Some of that is what we call stated capital, what you sold it for at par, additional paid in capital, proceeds in excess of par. You might have preferred equity. You have ending retained earnings. You have accumulated other comprehensive income. All right, so they might give you different pieces of the puzzle. You got to be able to put them together. Okay, so connecting of the dots, really an understanding of what it is you're doing. All right, let's see. Let me find a good one here, because I think I'm going way too, Sam, you think I'm going too easy on these folks? I think it's way too damn easy. What do you think? Let's make it harder.
If you want to ramp up the complexity a little bit, so far I think you're explaining all of this very well. I mean, we've not had any questions from our audience, so let's see if you ratchet up the sophistication and see what they do.
All right. Let's do it. Let's do it. So, you know, I think the ratios are a little bit too simple. I think we're going to move on after this to some leases. All right. So let me do one more here and then I'm going to move on to leases. All right. They want, hey, what is your financial leverage ratio? Well, I remember financial leverage. My profit margin times my turnover, my return on asset combined with my degree of financial leverage. There is your return on equity. You know what a common question is? How much money should you borrow? What is the optimal degree of financial leverage? Well, the degree of financial leverage is heavily dependent upon two things, just like individual investors. Number one, your ability to assume risk. As an entity, your ability to assume financial risk, borrowing money, you know what that's heavily dependent upon, that ability? What your degree of operating leverage is. How much operating risk do you already have? So as a general rule of thumb, when you have a lower degree of operating risk, if you want to, you could take on a higher degree of financial leverage to amplify your degree of total leverage. You could do that. When you already have a higher degree of operating leverage, though, you probably don't want to compound that with a high degree of financial leverage because that will run you into bankruptcy many times. To be bankrupt, you don't have to have many quarters or years of poor performance. I mean, in the United States, it's less than $20,000 in unsecured debt, undisputed unsecured debt. You have 3 or more creditors who join together and file a petition, federal bankruptcy court, and say this entity is not paying these debts as they become due. Less than $20,000. All right. So, I mean, when you take on debt, you got to be careful. You got to be able to pay that interest legally required, as well as the principal when it becomes due. That's the beauty of equity. All right. Because dividends are not legally required, not even on preferred stock with a fixed dividend. It still gets declared at the discretion of the board. And equity, unlike debt, has no maturity date. All right. But not only is it based upon ability, but willingness. How aggressive or conservative do you want to be? Aggressive, you'll probably have a higher degree of total leverage. When you're more conservative, there's no right answer or wrong answer, right? You know, it all depends upon personality. All right, but how do you quantify degree of financial leverage? Well, degree of financial leverage, I showed you earlier, we got 2 ways of doing it here in financial statement analysis and accounting. Asset divided by your equity, or 1 plus your debt divided by your equity. Same result, different format. Okay, now, as we mentioned, when you combine anything with the income statement, if possible, these balance sheet numbers, wow, look at that. I'm seeing double vision. Balance sheet numbers, if possible, should be what? An average. Okay, because we're in the DuPont model, we'll be combining with profitability. All right, so what they're really testing here is, did you remember that? Okay, so this is all about long-term risk, capital structure, solvency, how the company raised their capital. All right, so this is all about long-term risk, long-term financial risk, looks at solvency, how the company raised its capital, the capital structure. All right, so let's see what we got here. So going back to the given information, let's see. We don't want our income statement, but I do have 2 years worth of information again. So I want my balance sheet information. Here we go. Here's my balance sheet. Okay, so prior year, current year, 2008, 2009. Okay, so my total assets divided by my equity. That's one way of doing it. So we could do 2009 and then we'll do 2008, or it doesn't matter. Let's do 2008, the prior year first. Okay, 2008, the prior year. So I want my balance sheet for 2008. All righty, so what are my total assets? 2008, 286.5, drop the zeros. 286.5. How much of that came from debt versus equity? Well, let's see, total stockholders' equity was 206. So missing pieces of the puzzle. They gave it to us, but if they did not, 286.5 minus 206, we can infer that the liabilities would be 80.5. All right, so asset divided by equity, 286.5 divided by 206, That gets me 1.39. That is my degree of financial leverage last year, the prior year. Okay, what about 2009? 2009, the current year. Again, I want my balance sheet. So total assets, current year, 364.5. 364.5. Now, how did we acquire those assets? Let's find the total liabilities. Ready? Total liabilities. Where are my total liabilities? We got the total current. Nope. Long-term debt. Let's just do total equity. Again, 217.5, easiest to back into it that way. So 217.5. There's my total equity. So my liabilities must be what amount? 364.5 minus 217.5. They got to be 147. 2009, take your asset divided by your equity. So my asset, 364.5 divided by my equity, 217.5. So what is my degree of financial leverage? 1.67. By the way, if you took 1 plus your debt divided by your equity, 1 plus my debt, 147 divided by my equity, 217.5, that's 0.67. 0.67, same result, different format. Okay, so whatever's easiest. All right, now we need our average. What is our average? So we started the year at what? 1.39. We ended with 1.67. Divide that by 2. What's my average? 1.53. Okay, so that is our average degree of financial leverage, closest to, we don't want the current year or the prior year, we want the average. All right, so in the DuPont model, when you mix income statement and balance sheet, you got to make sure you remember, you got to use an average. Okay, by the way, in this question, net income divided by our average assets. In this question, if we took our net income, given information, net income, let's see, net income, it's operating income, net income, current year, 53.9. And then I want my average assets. Take beginning of the year, take the end of the year, add it together, divide by 2. Average assets, 53.9. Divided by average assets, 325.5. My return on assets, 16.56. Okay, multiply that by your degree of financial leverage, 1.54. What's my return on my equity? 25.5. Okay, and you would get the same result if you took your net income and just divided it by your average equity. Net income, 53.9. What's my average equity? Take last year's equity plus this year's equity. 206 plus 217.5. My circle's following me. 217.5 plus the 206 divided by 2. That is 211.75. Return on equity. Same result, different formula. But we like the DuPont model. Why? Because it explains why we have that return on equity. Okay, we like it broken down into the details. Okay, one thing I want you guys to know, what's your hurdle when you borrow money? It's not your cost of debt, it's your after-tax cost of debt. So when you're determining whether or not it's a good idea to, borrow those funds, you might want to consider, do you forecast your return on asset being greater than your after-tax cost of debt? Let's say you borrow money at 10%, and let's say your tax rate is 30%. What's your after-tax cost of debt? 7. Okay, so long as you can forecast a return on asset greater than that after-tax cost of debt, then you might want to think seriously if you have the ability, and the aggressiveness to do it. You want to borrow those funds because your return on equity will be greater than your return on asset. Look at this question. While the return on equity was 25.5, the return on asset was only 16.56. They were able to amplify the return to the owners by borrowing funds. So when you look at a company's capital structure, there's a little bit of a signaling effect, possibly. All right, so when we look at the statement of cash flow, you're going to see there's different sections to it. We generally want to examine how a company's financing the acquisition, like in a merger. If you're very confident that this merger is going to work out, I'll borrow the money. And you know what? I'll buy out the shareholders of the company I'm acquiring. I'll borrow the money because I'm very confident I want to accrue all the benefits of this merger. If you're kind of confident, but not crazy off the charts confident, maybe you'll pay cash. I'm not going to borrow it, but I've got some surplus cash. I think I'll use my cash. If you're a little bit more pessimistic, I'm not going to buy you out. I'll give you my stock for your stock. If you gave me false information to entice me to buy your business, you ain't going anywhere. Because if I go down, you're going down with me because I'm not buying you out. I'll give you my stock for your stock. And if you gave me false information and this don't work out, my stock goes down, you're going to go with me. All righty. So a little bit of corporate finance there. Okay, let's jump ahead now. So that's kind of a good feel for ratios. I mean, I could go on and on, but I want to jump ahead. I want to do some leases. So if you would jump with me, jump around, jump up and get down. Let's do some leases. Where are you? I look at all these questions. I'm nuts. Like as if I was going to be able to do all this, but we do in the course. We love it. We love it. We love it. We love it. Love it. Love it. Love it. All right. I know I got a bunch of lease questions here towards the back end. So let me find those lease questions. Look at all the questions you have to work. Lots of things to look forward to. Oh my goodness. All right. Let's see. Leases. Oh my gosh. More DuPont. Oh man. I was thinking we were going to like midnight tonight. That's a lot of stuff right there, boy. Uh-oh. I gotta let this catch up. So while my computer is catching up, leases, US GAAP versus IFRS, they are not the same, folks. You got to be very, very careful with the leasing rules. US GAAP and IFRS are not the same. Okay, similar, but not exactly the same. One thing that's no longer going to happen is what we call off-balance sheet financing. Whether it's an operating lease, which tends to be short-term, or it's a financing lease that tends to be more long-term, step number one, we're going to calculate the present value of the lease obligation, and that's going to be recorded as both an asset and a liability, as if you borrowed the money to buy that asset. So it's as if you borrowed the money to buy that asset. We record an asset and a liability. Okay, under IFRS, the way you record leases, there's just one way to do your lease accounting. It's very simple. You're going to record interest expense as if you bought it with borrowed funds, and you're going to record depreciation expense as if you bought it. Okay, so you're going to record interest expense and depreciation expense as if you bought that asset. Okay, now under US GAAP, it really depends upon whether it's an operating lease short-term or it's a financing lease long-term. Okay, under US GAAP, if it's a short-term operating lease, there's no depreciation, there's no interest expense. They just record lease expense, the rent payment. Generally, it's straight line recognition of the rent expense. Okay, so there's no depreciation, there's no interest. Okay, they're going to record lease expense. All right, that's it. Okay, now a financing lease, more long-term, then you're going to do pretty much the same thing as what IFRS does with its leases. You're going to record interest expense as if you borrowed money to buy it, and you'll record depreciation expense. Okay, you'll record both. All righty. So let's take a look now. My computer caught up. Let's get to our lease questions. Sam, any questions for me while I'm scrolling through here? I had bond stuff. I look at all this beautiful stuff I had. But bonds aren't tested as much as they used to be at level 1. Is that correct, Sam? They kind of cut that back quite a bit, didn't they?
Well, I wouldn't say quite a bit. It is less than it was, but it's still fixed income is still a pretty heavy topic on that, and it'd be nice. We will do another webinar in a couple of months on fixed income. But as far as questions right now, no, Mr. Olinto, we have nothing for you.
All right. So my computer is very, very slow, as you can see. You know what I'm going to do? While this is loading up, I'm actually going to change gears. Rather than doing leases, let me jump to earnings per share, and then I'll come back to leases when my computer catches up here. So let's do earnings per share. How's that sound, Sam? You like earnings per share? I like earnings.
I love them if they're positive.
Yeah, yes, sir. You know it. All right, let's see what we got. So EPS and statement of cash flow. All right, so we got our very first slide. All right, when you do earnings per share, folks, earnings per share, there's something called basic EPS, and then there's something called diluted EPS, which is a rule of conservatism. We always have to calculate basic EPS first, kind of gives us a benchmark, but then we calculate fully diluted. It's a what if analysis. Like, what if the company has what's called a complex capital structure? So let's say they have convertible bonds, or maybe they've got convertible preferred stock, or maybe they have outstanding options or warrants. The company has to show the world that, hey, what if this company, the preferred stockholders converted to common, or the bondholders converted to stockholders, or the options or warrants are exercised? What would that do to EPS? Now, it's possible it could make EPS go up. We would not report that. The rule of conservatism states we are going to only report the potential bad news, not the potential good news, okay? So diluted is always less than or equal to the basic. If something's anti-diluted, we ignore it and just say, hey, it's the same as basic. Basic EPS, you start with your net income, you back out the preferred dividends. Now, on the CFA exam, unlike the CPA exam, the presumption is it's cumulative preferred stock. Cumulative means I don't care if the preferred dividend is declared or not. We'll calculate the amount that accumulates to the preferred stockholders, so that if someday dividends are declared, we got to make the preferred stockholders whole, okay? That's also known as income available to common stockholders. We divide that by the weighted average number of common shares outstanding. That gets us basic EPS. Just calculating the denominator could be its own question. We generally weight things by month for simplicity, except for stock dividends and stock splits that we treat retroactively, as if it happened at the beginning of the year. Okay, so let's see our first question here. They want basic and they want diluted EPS. Remember, diluted always has to be what? Less than or equal to. So that doesn't allow me to eliminate any choices because they're all less than or equal to. All right, so now I got to do the work. Step one, I set up my formula. Net income minus my preferred dividends divided by my weighted average common shares outstanding. So I'm going to look for my given information and start plugging in. Net income, 2,440,000, pop it in, 2,440,000. We got one piece of the puzzle. Drop the zeros if you can. Okay, preferred stock, 12% return. There's $850,000 of preferred stock out there. What did we promise them? 12%. Multiply that by 12%, $102,000. Again, the assumption is whether they declared it or not, this is the amount that's accumulating. That is not available to common stockholders. They have to pay preferred stockholders before the common stockholders see anything. So that gets me my numerator. Okay, income available to common stockholders. Income available to common stockholders, 2,338,000. That's your numerator. Now I need my weighted average shares outstanding. Okay, dividends paid to common stockholders is distractor information. Get it out of there. We want, if anything, dividends preferred, not common. The weighted average number of shares outstanding, given information, we didn't have to solve for it, 2 million, beautiful, we got that piece of the puzzle. So now I have my basic EPS, 1.169, approximately 1.17. You know your answer's gotta be big. We don't want to unnecessarily do work exam day. We don't even really have to do diluted. We're going to do it anyway. But exam day, if there are multiple columns like that, sometimes one calculation will solve it. Okay, but we're going to do it anyway. Now, how do we do fully diluted? Well, I'm looking to see, do they even have a complex capital structure? Do they have convertible preferred, convertible bonds, options, or warrants outstanding? They don't need all of those, any one. So I keep reading, I see the word convertible. That means they have a complex capital structure. That means I've got to do diluted EPS. All righty. Now, with convertible bonds, as soon as I see convertible bonds, there's good news and bad news. If that debt converts to equity, the good news is our numerator goes up. We're going to have our saved interest expense net of tax. You lose the tax deduction on the interest, so that's why we add back the saved interest net of tax. So my net income minus my preferred dividends, $2,338,000. That's the good news. I save interest. The bad news is the number of common shares that have to be issued to the bondholders. Your conversion ratio. For every bond they own, how many shares of common stock do they get? Okay, that's called your conversion ratio. For every bond they own, how many shares of stock do they get? So now I read the facts. My debt, $100,000, trading at par, 8%. So we know our interest, $100,000 times 8%, $8,000. But that's not what we're adding back. Remember, we're adding it back net of tax. That's why it's so important you write that formula down. So now I'm looking for my tax rate, 35%. I multiply that by 1 minus the tax rate. How much interest am I saving net of tax? $5,200. Dropping the zeros, I'm adding 5.2 to my numerator. My weighted average shares outstanding was 2 million. How many shareholders now are there going to be? The incremental shareholders. Well, let's see. They tell me they're convertible into 20,000 shares of common stock. That's the conversion ratios. The number of common shares you're going to get on a per bond basis multiplied by the number of bonds, the number of common shares per bond times the number of bonds outstanding. That gets you the incremental number of common stockholders. They gave me this number right here. Okay, they gave me that number right there, 20,000. All right, so they did me a favor. I didn't have to do any work. So I'm going to drop the zeros. I'm going to add 20 to my denominator. Okay, so 2338, add the 5.2, but now we're going to divide by 2020. What do we get? 1.16. Is that less than the basic? Yes, it is. So would we report that? Yes, we would. All right, so that's where they get the 116 from. Okay, let's try another one. Let's see, which of the following is least likely? Which of these is not an example of a potentially dilutive security? Preferred shares. It's got to say convertible preferred shares. If all it says is preferred shares, that is not potentially dilutive. That's the correct answer. Stock options, warrants, that's potentially dilutive. Convertible bonds or convertible preferred equity. You got to see the word convertible. By the way, when you do your potential conversion, for stock options and warrants, we use something called the treasury stock method. For convertible bonds or convertible preferred equity, we use what's called, well, what if they converted? The if converted method, okay? Just another theory item. So notice how some questions are designed to be answered in 10 seconds. You have an average at level 1 about a minute and a half a question. But a question like this, you're going to get it right, and you're going to get it right in 10 seconds because now the next question might take you closer to 3 minutes. All right, so don't spin your wheels on a multiple choice. If you don't know the answer, guess and move on. You leave nothing blank, but don't spin your wheels. If you're going to get it wrong quickly. Or if you're going to guess quickly. All right, again, they want basic and diluted EPS. So what is my basic EPS? Net income minus my preferred dividends divided by my weighted average common shares outstanding. Okay, so that's where we're going to start. Net income, looking for that. I see it, 2,360,000. We got one piece of the puzzle. Preferred stock, $500,000 of preferred equity out there. That's your number of preferred shares times the par value per share. They gave us the 500,000, but if they didn't, that's how you'd find it. What's the rate of return? 10%. So what did we promise these folks? 50,000, drop the zeros, 50. My income available to common stockholders, 2272.5. That's your income available to common stockholders. Dividends paid to common stockholders, distractor. Weighted average shares outstanding, drop the zeros, 500,000. What is my basic EPS? 4.545, approximately 4.55. We'll round up. Again, you know your answer's got to be B, just based upon that. Okay, but now I see that the company has convertible preferred shares. Okay, convertible preferred shares. Whenever you see the word convertible, complex capital structure. Okay, complex capital structure. Now, I made a boo-boo. I thought my preferred dividends were just the 50. There's actually two classes of preferred shares. So my preferred dividends are not just 50. So I'm gonna have to redo my math. You ready? What is my total preferred dividends? Well, I have convertible and non-convertible. The non-convertible preferred equity has preferred dividends of 50. What about the convertible preferred equity? I've got 500 shares, pay a dividend of $75 per share every year. 500 shares times the dividend of $75 per share. That's 37,500. Dropping the zeros, that's 37. Ooh. So my total preferred dividends are actually 87, not 50. So my income available to common stockholders, 2272.5. Okay. I had that number there before, but I did not subtract the right amount of preferred dividends. You got to make sure you understand we have two different classes of preferred shares. Okay. Now, my income available to common stockholders, 2272.5 divided by the 500. That's that 4.545 that I showed you earlier, or 4.55. That number was correct, as was this number. It was this number. Okay. Obviously, if you did not prepare this in advance, you would have got that wrong if you subtracted 50. Now, when I do my diluted, I start with my income available to common stockholders. Income available to common stockholders, 2272.5 divided by my weighted average common shares outstanding, 500. Now, folks, dividends are not tax deductible. Dividends are not tax deductible. So we're going to add back, here's the good news, the saved preferred dividends. Okay, but here's the bad news. Here's the number of new common shares that are going to be issued if the preferred stockholders convert. This is the only class that is convertible. Okay, each convertible preferred shares can be converted into 50 common shares. We have 500 convertible preferred shares times 50 common for every share preferred. That works out to be, let's see, 500 times the 50, 25,000. New common shares, 25,000 new common shares. Going to get rid of that arrow. So 25. Now, which of these dividends would we save? Not all 87, folks. We would only save the 37. And actually, that's 37.5 to be exact. That's 87.5, 87.5 to be exact. Okay, so I would save 30 only, quote unquote, only, not all the preferred dividends, just the preferred dividends on the convertible preferred shares. And we ignore taxes. When it comes to the convertible preferred, we ignore taxes, totally irrelevant because dividends are not tax deductible. So now when I crunch these numbers, what do I get? 4.4. Is 4.4 less than 4.55? Yes, it is. So this is dilutive. Okay, diluted. This is potential bad news. So 4.4 Correct answer. All righty, so let's try another one. Now this question is just gonna test, hey, can you calculate the weighted average shares outstanding? That's what this is really about, okay? They tell me, what is the company's EPS? When they don't say anything and they just say EPS, that means it's basic. So net income minus preferred dividends divided by my weighted average common shares outstanding. All right, so the first thing I'm looking for is my net income, 3,340,000. Are there any preferred dividends? I scan my information, no preferred stock. Now I've got to calculate my weighted average common shares outstanding. What you always do is look for stock splits and stock dividends. We deal with those items retroactively as if they happened at the earliest point during the year. So stock split, stock dividend, we have both. Okay, now I'm going to set this up. Are we a calendar year or a fiscal year? Calendar year. Here's the beginning of the year. January 1, 2 million shares. So there are multiple ways of doing this. You know, speed is important, but it's secondary to accuracy. So I'm going to do it. You know, this is the way I teach it in college. This is what works best for me. So January 1, I start off with 2 million shares. Okay, I'm going to drop the zeros. I'm just going to make it 2,000. On March 1st, I had a 3-for-2 split. I got to deal with that retroactively. And then I had the stock dividend was on what date? October 31st. What kind of stock dividend did we have? 5%. So whatever amount of shares you had outstanding, you're going to multiply it by 5%, 1.05. Why 1.05? Because you have 100% of what you had before and another 105%. All righty, so my split, 3-for-2, so take the 2 million, multiply it by 3/2, and your stock dividend, 1.05. Now I'm going to pretend my adjusted balance, I'm pretending I started the year with 3,150,000 shares. Anything before these two dates has to be retroactively adjusted. Anything before those dates, we retroactively adjust. Okay, so for the shares issued on July 31st, the 3-for-2 splits got to be considered. So on July 31st, we issue how many shares? 200,000. Okay, we issued. So, you ready? Let's see. This 3-for-2 split, that's already happened, but the 5% stock dividend, we've got to retroactively adjust for that. Okay, so we have to retroactively adjust. So any events that happen prior to, the only thing prior to the 3-for-2 split was the beginning balance. But for the 5% stock dividend, there were 2 events, or actually 3 when you consider the split as well. Okay, so for the 5% stock dividend, this is what we're going to do. Since July 31st is after the 3-for-2 split, we ignore that, but it's before October 31st. So instead of saying I issued 200,000 shares, no, I'm going to pretend I issued 210,000 shares, giving me 3,360,000. 3,360,000. And there should have been a 0 there. Okay. Now, what's the only other event that happened? Shares were repurchased on December 1st. Okay, December 1st. That's after the 3-for-2 split. That's after the stock dividend on October 31st. So that does not get adjusted for either one of those events because that happened after the stock dividend, after the stock split. So I'm going to repurchase 100,000 shares, got repurchased, put them into treasury stock. Now we have 3,260,000 shares outstanding. So now we have to weight everything. From January 1 to July 31st, how many months is that? 7 out of 12. From July 31st to December 1st, July 31st to December 1st, that's how many months? That's 4 months out of 12. From December 1st to the end of the year, December 31, that's 1 month. So we've got to wait the 3,150,000, the 3,360,000, the 3,260,000. So 3,150,000 times 7/12, 1837.5. The 3,360,000 times 4/12, that's 1120. And then the 3,260,000 was only outstanding 1 month, so that's 271.67. What's our weighted average common shares outstanding? 3229.17. 3229.17. We got another piece of the puzzle. Okay, so 3340 divided by 3229.7. What's our basic EPS? 1.034. Choice A. All righty. So that question just focused in on the denominator. The key takeaway is stock dividends, stock splits, we deal with retroactively. Any events that happen prior to that date, we got to retroactively adjust for, okay? So we put it in order, beginning of the year, 2 million. All right. We have to consider both the March 1st and the October 31st event because January 1st is prior to those two events. So we adjust for the stock split, we adjust for the stock dividend. The July 31st event is after, and that, I don't know how that moved, but 200,000 shares were issued. Okay, that's after, July 31st is after the March 1st event, so we ignore that. But the July 31st event, okay, is before the October 31st event. So we got to adjust for that stock dividend. All right. Lastly, December 1st, we repurchased 100,000 shares. That's after the split. That's after the stock dividend. So we ignore that. Okay. We go all the way to the adjusted balance column and then weight everything. Okay, cool. So there's our basic and diluted EPS. The only thing, other thing I wanted to show you, let's see. Sorry about that, folks. My computer's a little bit frozen here. Come on, guys. Let's see. Come on, man. Let's see here. Nope, not gonna happen. All right, let's move on. Let's do some cash flow. We got a bunch of EPS stuff done. So I want to jump ahead here. If you would, let's do some statement of cash flow. Statement of cash flow. Now there should be another way, but that's not working. All right, let's see. Statement of cash flow, don't you know that's EPS? All right, there we go. Statement of cash flow. Okay, folks, for statement of cash flow, 3 major categories you guys got to know the difference between. You got cash flow from operations, and let me just expand that. That focuses in on the change in most current assets and most current liabilities. It focuses in on really the change in your working capital, but technically it's the change in your operating assets. All current assets except cash and cash equivalents. What's a cash equivalent? Short-term, highly liquid fixed income with an original maturity of 3 months or less. It focuses in on the change in your operating liabilities, non-interest bearing liabilities, non-interest bearing. So that's most current liabilities, deferred tax liabilities, cash flow from investing, as I write a note. That focuses in on the change in your non-current assets. Things like your property, plant, and equipment, long-term investments, most long-term investments in other companies, most of those. I'll show you an exception in a little bit. And your intangibles. Okay, your intangibles, patent, copyright, trademark, franchise, license, things of that nature. Then you have cash flow from financing, which focuses in on the change in your own debt, short-term or long-term. The key is it's got to be interest bearing. It's got to be interest-bearing debt. Sorry, guys, my computer battery's about to die. Hold on, hold on. Hold on, hold on. Hold on. You saw my shorts? Did you guys see my shorts? Oh, no. I think you guys saw my shorts. Sorry about that. Yes, I'm in shorts. I'm in Florida. Interest-bearing debt. What do we mean by interest-bearing debt? Put this back on. Look for the word note, bond, or they use the word debt, debenture, a mortgage, a line of credit. That's all interest bearing. Okay, those are financing liabilities. Changing our own debt and changing our own equity, whether it's common equity or preferred equity or treasury stock. When you repurchase your own stock, it's called treasury stock. Or you pay a cash dividend. It's got to be paid, folks, and it's got to be cash. So those are our three major categories. What does a statement of cash flow really tell us? It explains why. It's kind of like the DuPont model. It explains why cash changed. So the beauty is it explains why. So folks, I would love to be able to generate cash from my core business. If you can't generate cash from your core business, you're going to be out of business. You know what operating cash flow helps us determine? Quality of those earnings. What don't we want to see? That your accrual basis earnings period after period is going up, but your operating cash flow is not growing with it. That's not a good sign. Cash flow from investing, counterintuitive. When it's positive, the company's downsizing. That means their growth rate is going down. It's counterintuitive. If you're selling off your stores, your factories, your PP&E, you're not growing, you're downsizing. When it's negative, you're on the buy side. Now you're growing. Now you're growing. And cash flow from financing could be positive or negative. It depends upon cost of capital, but a savvy investor looks for what's called the signaling effect. The signaling effect. When debt goes up, equity goes down, that could be a sign of optimism. The company must feel that their return on assets is going to be able to cover that cost of debt, so they want to take on that additional risk to amplify the return to the owners. If the debt's going down and the equity is going up, that could be a sign of pessimism. All right? They're paying down their debt. I mean, think about it logically. Like if you got a big bonus at work, if you took that money and paid down your debt, instead of investing in the market, which you could have done, but if you're not feeling so good about investment opportunities and you pay down your debt, that could be a sign of pessimism. All right. Conversely, if you borrow money, unless you're crazy, which a lot of people are in the US, borrowing lots of money. But look, it's signaling. All right. So it's part of the big package of things we look at. All right. So let's take a look at a question here. Hey, what's most true about transaction number 3? So all we're looking at is I'll do all of these, but let's just look at transaction number 3 first. We invested excess cash amounting to $12,000 in securities classified as held for trading, and then another $8,000 held to maturity. Stop right there. Folks, when you buy stocks and bonds of other companies, when you buy stocks or bonds of other companies, as a general rule, that's cash flow from investing and outflow when you're on the buy side. The major exception is when we have what's called a trading security, also known as held for trading, also known as fair value through P&L. That's generally a current asset. That's cash flow operating. When you buy an asset, assets go up, that's an outflow, cash goes down. When you sell the asset, assets go down, that's an inflow, cash goes up. All righty, so let's read that again. We took $12,000 of cash. We put some of that in what's called held for trading. Okay, held for trading, also known as fair value through P&L. That's cash flow operating. All right. We took another 8,000, classified it as held to maturity, also known as amortized cost. That's cash flow investing. The only one that's not investing is the fair value through P&L, the held for trading security. Sometimes it's called a trading security. If it's a current asset, cash flow from operations. Okay, so it's going to increase, not increase, it's going to decrease cash flow. We were on the buy side. It will decrease cash flow from operating by 12,000. Yes, for the trading security only, the held for trading, the fair value through P&L. That's got to be the true statement. It's going to decrease cash flow from investing. Yes, it will decrease. We were on the buy side, but not by 20,000, just by 8,000. Okay, because the 12,000 was cash flow operating. Okay, let's try another one. They love differences between IFRS versus US GAAP. Interest paid under IFRS, that's either cash flow from operations, and if you're paying it, it's an outflow, or cash flow financing. Which one says that? Choice B. US GAAP, interest paid, cash flow operations. Dividend paid, cash flow financing. Under IFRS, interest paid as well as dividends paid, cash flow operating or cash flow financing. IFRS gives you options, okay? Now, interest or dividend received. Under US GAAP, cash flow from operations. Under IFRS, that's going to be cash flow from operations or cash flow from investing. Generally, if you're a bank, then paying cash, receiving cash, it's part of your core business. They make money on the spread. Okay. So let's try another one. They want to know Capital One Bank. So as soon as you see bank, this is an exception to the general rule, okay? Interest received, cash flow operating. Interest paid, cash flow operating. Why? Because this is what a bank does. This is their core business. So for a bank, whether it's US GAAP or IFRS, doesn't matter, okay? It does not matter. So when you're a bank, that's your core business, okay? So they were the lender. The Capital One Bank was the lender. Who was the borrower? Pharma company. They're the borrower. Okay, they're the borrower. So when you borrow money, okay, loan to be repaid in 5 years, that's interest bearing debt, financing liability. Cash just went up. Okay, so that's cash flow from financing and inflow. That's a financing liability. Cash went up, cash flow from financing inflow. So for Capital One, the bank, that's operating. Okay, for Pharma One, the borrower, that's a financing activity. All right, choice C. Let's try ourselves another one, but I want to do some math. I don't want the theory, I want the math, baby. Show me the math, show me the math. All righty. Let's see, let's jump ahead, jump around, jump up and get down. All right, let's see. We want math. So let's get to a really challenging one. Here we go. Here we go. We like the math. All right, there we go. Okay, so take a second. Again, lots of information, don't know what to do with it. They want cash flow provided by financing activities. Okay, I'm going to set this up so no matter what they ask, we're going to review the rule in its entirety. I'm thinking of retirement. Okay, proceeds from the sale of equipment. That is a non-current asset. That's an investing inflow. Proceeds from the sale of our own stock. When you sell your own stock, that's not somebody else's stock, that's our own stock. Financing inflow. Purchase of a bond. We bought another company's stocks or bonds. As a general rule, investing outflow. Buy another company's stocks or bonds, major exception, if it's fair value through P&L, a trading security held for trading, then that would be cash flow operating. A gain on the sale of equipment, that's an adjustment to net income to arrive at cash flow from operations. Okay, an adjustment to net income to arrive at cash flow from operations. Dividends paid under US GAAP, financing outflow. Under IFRS, that could be operating outflow or financing outflow. Dividends declared not on the statement of retained earnings, not on statement of cash flow. It's got to be paid, and it's got to be a cash dividend, not property, not stock. It's got to be a cash dividend. So that 560 doesn't go anywhere on a statement of cash flow. That's part of the company's statement of retained earnings. Amortization of a bond discount, that's an adjustment to net income to arrive at cash flow from operations under what's called the indirect method. So the financing activities, the change in our own debt or equity. The default rule, folks, on the CFA exam, when they say nothing, you are to apply IFRS. Okay, when they say nothing, you are to apply IFRS. So we know we definitely have a 750 proceeds from the sale. We got a 750 inflow. And then the only other outflow, when they say nothing, if they say nothing, IFRS, and if they say nothing, when the question is silent, assume. IFRS uses same rule as US GAAP when they say nothing. So the dividend paid, absent any other information, it could be financing outflow, so we'll do financing outflow. 460 outflow, 750 minus 460. Cash flow from financing, 290. Okay, so 290. Okay, how about cash flow from investing activities? Well, what were our investing activities? We had an investing outflow, 1670, and we had proceeds on sale, 340. So we had two investing activities. We had the 1670 outflow, 1670 outflow. We had the 340 inflow. So my net outflow, 1330, net cash flow from investing and outflow, 1330. Okay, now let's do another one. Let's do a nice cash flow from operations. Okay, let's take a look at cash flow from operating activities. Folks, there's two ways to do cash flow from operations. Same result, different format. You can do what's called the indirect method, which is a reconciliation of accrual basis net income to the cash generated from your core business. You got to know this inside and out. You take your net income, you add back your depreciation and most amortization. When you see the word amortization, it's a non-cash expense, just like depreciation. It makes net income go down, but no cash goes out the door, so we add that back. You add back losses. Why? It makes net income go down, but by definition, a gain or a loss is not from your core business. It's non-operating. You subtract gains and amortization of a bond discount. That's the only type of amortization that gets subtracted. Gains and amortization of bond discounts, that makes your net income go up, but it's not part of your core business. So we're going to subtract that out. You're going to add your change in operating liabilities, direct relationship, keep the sign, Subtract your change in operating assets, you do the opposite, inversely related. Asset goes up, you subtract it. There's your cash flow from operations. Oh, cash flow from operations. It won't let me write it, but there's your cash flow from operations indirect method. If you're doing the direct method, you take your cash collected from customers minus cash paid for all operating expenses, things like salaries, rent, insurance, utilities, all your SG&A, all that stuff. You subtract out all the cash paid for your operating expenses. There's your cash flow from operations. Same result, different format. The beauty of the indirect method, though, it helps us assess quality of earnings. What's a major red flag? When your accrual basis earnings is going up, but I don't see the cash generated from the core business, that makes me very nervous. All right, that makes me very nervous. All right, quality of earnings, you know, they should be growing at a similar rate. All right, any period, accrual basis net income is not going to equal cash basis because there's a timing difference as to when you record your revenues and expenses. I get it. But if quarter after quarter, year after year, you're showing me on the income statement that your earnings are growing, but I don't see the operating cash flow growing with it, I start to get very nervous. Okay, so how do they want me to calculate cash flow from operations? As soon as you see cash received from customers, you're thinking direct method. All right, now we're going to subtract out all of our operating expenses. Cash paid to suppliers, that's an operating expense. Operating expenses like SG&A, you're going to back that out. Cash paid for taxes. Now, unless they tell you otherwise, taxes and interest are an operating expense. Okay, even if it's IFRS, interest and taxes, operating outflow, unless they tell you otherwise, because under US GAAP, this has got to be an operating outflow. Okay, so we subtract that. So all three of these get subtracted. So what's our cash flow from operations when you net it out? 5250. So take the 27,300, back out your operating expenses, 5250 is the cash flow generated from the core business. Okay, the problem is I don't see what my net income is, so I can't do that reconciliation. All righty. So direct method, indirect method, same result, different format. Okay. Now they want cash paid to suppliers. How do you find your cash that you actually paid to your suppliers? We're going to look at our cost of goods sold, an expense, a presumed outflow, but that's accrual basis. You're then going to look at your change in inventory. If inventory goes up, you're on the buy side, that's an outflow. If inventory goes down, you're on the sell side, that's an inflow. You're going to look at your change in accounts payable. If it goes up, you're borrowing. That's an inflow. If it goes down, you repaid the vendor. That's an outflow. Here's your net cash paid, your net cash paid. All righty. So cost of goods sold, my starting point, $44 million. What happened to my inventory? It went down, it decreased. When your inventory goes down, that means you're selling. When assets go down, cash goes up. That 7 million is an inflow. I'm going to subtract that. My accounts payable, I have an increase. Anytime a liability goes up, borrowing, a source of capital. Okay, when equity goes up, you're issuing, you're raising capital, direct relationship. So that's an inflow of 4 million. We're subtracting that inflow. What's the net cash paid? 33 million. 44 minus the 7 minus the 4, $33 million. Now, oh, sorry about that. 33, well, it's not allowing me to do it. Come on, man. Sorry about that. $33 million. There we go. Okay, now, do you see the sales and the accounts receivable? That helps me find cash collected from customers. When you take your net sales, that's a presumed inflow. What does net sales mean? Net of any returns and discounts, okay? You then look at your change in accounts receivable. If accounts receivable goes up, that means you accrued for the sale. It's an accrued sale. There's no cash yet. You treat that as an outflow. If accounts receivable goes down, that means you collected cash. That's an inflow. And there's your net cash collected from customers. Net cash collected from your customers. So in this question, what were our net sales? $85 million. That was our revenue. What happened to our accounts receivable? We have a decrease. Why does accounts receivable go down? Because cash is collected. Cash goes up. So that's an inflow of $5 million. So what's the cash collected from customers? 90 million. You need those numbers to do your direct method. Okay, let's try another one. You ready? They want cash flow from financing, but I'm going to do a lot of things with this question. Okay, even though they ask for financing, I'm going to want to do operating anyway. Okay, I'm going to do the indirect method. Since I have this, I want to do cash flow from operations using these facts. I want to do the indirect method. So if it's the exam, how do you know you've got to do the indirect method? You see words like net income and depreciation, okay? With the direct method that we did earlier, that direct method, we ignore. When you do the direct method, you ignore depreciation, amortization, gains, losses. That all gets ignored, okay? That's only relevant when you're doing the indirect method, okay? Same result, different format. Okay, so here we go. Cash flow from operations, you ready? Net income, add back depreciation and most amortization, except for amortization of a bond discount. Add back your losses, subtract your gains and amortization of a discount. You're going to add your change in operating liabilities, subtract your change in operating assets, cash flow from operations. So let's do it. Net income, 1120. We got one piece of the puzzle. Depreciation and amortization, add it back, 27. Losses, I don't see any. Gains or amortization of a bond discount, I don't see any. All right, now I'm looking for change in operating liabilities or operating assets. A decrease in inventory, that's an operating asset. We do the opposite. Since it decreased, I'm going to add that 13.8. An increase in taxes payable, non-interest bearing, that's an operating liability. Keep the sign. I'm going to add 1.5. Issuance of common stock, that's a financing. And that's an inflow because I issued it. Dividends paid, financing outflow. Purchase of land, investing outflow. That's a non-current asset. An investment in an associate. You bought stock of another company, investing outflow. Purchase of held for trading. Since it's held for trading, that's cash flow from operations. So that's a purchase. So that's a cash outflow. That's an operating outflow. That would be an operating outflow. Why? Because we're on the buy side of that transaction. So that's a 7.2. I'm going to subtract that. Available for sale securities. That is cash flow from investing. That's also known as fair value through OCI, 84.7. We're on the sell side, so that's an investing inflow. Okay, investing inflow. But my cash flow from operations, 1155.1. Okay. Now, what about my financing? There were only two transactions here that we identified as financing. The $60,000 inflow, the 32.3 outflow. What's my cash flow from financing? 27.7. Hopefully that's a choice, and there it is, 27.7. All righty. Now, let's try another one. Let's see. Now, remember I was saying earlier about connecting the dots? Take a look at this. If the company's accounts payable increased by 4, what's the cash paid to the suppliers? Okay, the cash paid to the suppliers. Well, they tell us we have a profit of 104 million, revenue of 500 million, cost of goods sold 270. We had purchases of 40. All right. So accounts payable increased by 4. How much was the cash paid to the suppliers? So another way to find cash paid to suppliers, if you have your purchases, so this is another methodology, same result, different format. You have your purchases. Look at your change in your accounts payable. If accounts payable goes up, you're borrowing. Purchases and outflow, that would be an inflow. If accounts payable went down, you repaid the vendor, that's an outflow. And there's your net cash paid. How do you get purchases if it's not given? Remember, beginning inventory plus what you purchase. That tells you everything you have available for sale, cost of all goods available for sale. Subtract your ending inventory, there's your cost of goods sold. But we're given purchases were 40. So that's my starting point in outflow. Okay, change in accounts payable. It increased. When liabilities go up, you're borrowing. That's an inflow. That's a source of capital. So that's a 4 inflow. 36 million. Okay, remember the alternate approach is cost of goods sold. You'd have to look at your change in accounts payable as well as your change in inventory. You'd have to have both of those accounts, okay, to find your cash paid to vendors. You'd have to have both. I don't have my change in inventory. They did give me my cost of goods sold. My cost of goods sold was 270. And outflow. My change in accounts payable, when it goes up, borrowing. Inflow goes down, repaid. Outflow. Here we have a 4 inflow. And then your change in inventory. When inventory goes up, you're on the buy side. Cash is going down. That's an outflow. When inventory goes down, you're on the sell side. Cash is going up. That's an inflow. All righty. So you would get the exact same result, just a different format. But you need the change in inventory account if you're going to be starting with cost of goods sold. Okay. Let's see. Let's try another one. Let's get a goodie. Let's get a goodie. A goodie. Let's see. Nah, it's too simple. Here we go. Let's do another indirect method. I like it. All right, let's do this one. Let's do it. Here we go. Start with your question stem. What is your cash flow from operations? As soon as I see that, I'm thinking, am I going to do direct method? Did they give me cash collected from customers? Or am I going to be doing indirect method? How do you know it's the indirect method? They give you things like net income, depreciation, gains, losses, all that kind of stuff. So I scan. What did they give me? They gave me an income statement. Anytime you have an income statement, you're going to be doing your indirect method. All right. So net income, add back depreciation and most amortization. Add back your losses, subtract your gains, and amortization of a bond discount. The disco gets subtracted. We don't like that anymore. You're going to add your change in operating liabilities, subtract your change in operating assets. There's your cash flow from operations. Oh my God, we're going overtime. Nobody worry. Stay cool. Let's do this question. All right. So net income, 400. Do we have depreciation? Yes, we do. 200. Do I have any losses? I do not see any losses, but I do see a gain of 30. We're going to subtract out that gain. Now I'm looking for changes in operating assets and operating liabilities. You need your balance sheet for that. So now I go to my balance sheet. Okay, here's your ending balance. Here's your beginning balance. Okay, current year, prior year. All right, by the way, my change in cash, this is my check figure. It went from 100 to 895 plus 795. When you're done with your statement of cash flow, you better get 795. The change in cash, we better get a plus 795 or you did something wrong. All right, so let's see what we got. So accounts receivable, operating asset, it went from 200 to 260 plus 60. Inventory, operating asset, from 800 to 500, 300. PP&E, that's cash flow from investing, that's a non-current asset. Liabilities, accounts payable, non-interest bearing, went from 350 to 370. That's a plus 20. Bank notes, I don't care if it's short-term or long-term. Financing, minus 100. Deferred taxes, that's an operating liability. Even though it's long-term, it's still an operating liability, from 40 to 90 plus 50. My own equity, this is cash flow financing. We'll deal with that in a second. Okay, so let's plug in now. I need my change in my operating assets. Do the opposite, subtract 60, add 300, keep the sign for the operating liabilities, that's a plus 20. So let's pop that in. You ready? So my change in my operating liabilities, a plus 20, accounts payable went up, plus 20, deferred tax liabilities went up, keep the sign. Change in my operating assets, accounts receivable went up, so I'm going to subtract that increase in accounts receivable. We do the opposite. Inventory went down. My inventory went down, so that I'm going to add 300. Cash flow from operations, 88. We have one piece of the puzzle. If we were going to find the change in cash, we have one piece of the puzzle. Cash flow from operations, 88. Okay, 88. So cash flow from operations, 880. So dropping the zeros, 880. All righty. Now, let me see if I can find the other two pieces of the puzzle, and then I'll let you guys get to the library and review. You ready? Let's find our cash flow from investing. Let's see if we can actually get that plus 795. Okay, let's see. Let's challenge ourselves. So cash flow from investing, my PP&E, notice this is net of depreciation. So this is what I want you guys to do for your PP&E. You've got a beginning net book value of PP&E, all right? So what's our beginning net book value of PP&E? 500, that's where it started. What makes it go up? Capital expenditures, what you buy during the year, that makes it go up. What makes the net book value of PP&E go down? Current year depreciation expense. That number we saw on the income statement. What was our current year depreciation? 200. What makes the net book value of PP&E go down? The net book value of anything sold. The net book value of anything sold. Okay, the net book value of anything we sold. Okay, this is how you get your ending net book value of PP&E. Now we have our ending net book value of PP&E, don't we? That was given information as 300. Brackets, by the way, means I'm subtracting. Okay, now let's see. We've got other notes here. Old machinery was sold. The machine had been fully depreciated. What does that mean? Then the net book value, the selling price, minus the net book value of what we sold is how you get your gain or loss. Okay, so they tell me cost minus accumulated depreciation. I don't have either one of those numbers, but I do know that it's been fully depreciated. That means the net book value of what I sold was 0. Now, we did have a gain, didn't we? Yeah, we had a gain on the sale of machinery of 30. So we have a gain on the sale of machinery of a plus 30. So therefore, we can infer, working backwards, 30 minus 0. What must have been our selling price? It must have been 30. So I have a cash inflow investing. My proceeds on sale, 30. Now, I know the net book value of what I sold was 0 because it was fully depreciated. So the net book value of what I sold, 0. Okay, I did sell something, but the carrying value was 0. So that tells me, did I buy anything? I did not. I did not buy anything. Why not? Because 500 minus 200 is in fact 300. So that means what I bought must be 0. Okay, that's got to be 0. So my cash flow from investing, I only have that one item, a 30. So let me pop that in. Cash flow from investing, a plus 30. Okay, now what is my cash flow from, and that should be 880. Sorry about that, folks. Cash flow from operations is 880. Okay, 880. All righty. Now, cash flow financing. All right, so let's take a look at our cash flow. Let's take a look at all of our financing activity. You ready? Let's take a look at our cash flow from financing. Okay, we repaid a banknote financing liability. That is a financing outflow of 100. We took care of that. Okay, common stock and retained earnings. What happened to our common stock? No change. So I did not issue any stock. I did not repurchase any stock. So the change in my stock, 0. Okay, we have a financing outflow, repaid debt. Financing outflow, we repaid debt. All righty, so that's an outflow of 100. Change in stock, 0. There is none. All right, what else do we have? Retained earnings. This is what we're going to do with retained earnings. You ready? I want you all to understand how to find this dividends paid. What if that were not given? All right, I know that's a financing outflow. Okay, so we know our dividends paid, a financing outflow, dividends were paid. So dividends are paid 15. So that's an outflow. Okay, so we got that piece of the puzzle, but what if that were not given? Let's see, which column was which? So this is ending, this is beginning. This is what I want you all to do. A statement of retained earnings could be tested elsewhere as well. So my beginning retained earnings was 110. Beginning retained earnings, 110. Add your current year profit or subtract a current year loss. Per our income statement, we had a profit of 400. Now, what makes your retained earnings goes down? Dividends declared. What if we had to find that number? Well, let's see. Ending retained earnings was given information. What was our ending retained earnings? 495. That was given. Well, obviously 400 plus 110 is 510. Obviously, our ending retained earnings is 495. It's not 510. So that means we must have declared dividends of how much? 15. But that doesn't mean it was paid. You've got to take your dividends declared per your statement of retained earnings, 15. Okay. Then you've got to look at your change in your dividends payable. Dividends payable. If that goes up, your borrowing from your stockholders, you haven't paid it yet. If that goes down, you repaid what you owed. That was an outflow. Here's your dividends paid. And remember, it's got to be a cash dividend and it's got to be paid. We know that's 15, so that means there was no change to dividends payable. There was no inflow. We didn't borrow from them. We didn't outflow, no repaying. Okay, all we have, whatever we declared this year is what we must have paid. All righty, so now what is our cash flow from financing? Let's see. We have the 100 and the 15. So our cash flow from financing, we have a financing outflow. Cash flow from financing, we have a financing outflow of how much? 115. Okay, now if we did this correctly, 880 plus 30 minus 115, that would equal our check figure 795. And does it? Whoop, there it is. Whoop, there it is. Oh my goodness. So I went overtime here. I apologize for keeping you late, but I hope you got a lot out of this. Sam, I'm going to turn it over to you if I can. I know there's a slide you wanted to put up. So I'm going to stop showing my screen, so hopefully you can show your screen instead. And folks, while Sam's putting up his slide, if he can, it's information about the course and how to enroll. So I stopped sharing my screen, I think. I just want to mention to you guys, I didn't get a chance to do leases. So the next free level 1 webinar we do, and I will do leases and whatever other topic we choose, maybe fixed income, whatever it is. But obviously our goal is to earn your business, right? There's many topics on the exam. There's several beautiful components of this course. One of them is the pre-recorded lectures. You've got some of the best and brightest in the industry writing the content, recording the lectures. Darren DeGraff, Chris, just a phenomenal team across the board that Sam's put together. So kudos to Sam. We also do the Saturday live online or on demand. I think I already recorded, and Darren did and Chris did. So the end of chapter questions solved for you, not every single one, but the harder ones, so that you have detailed explanatory answers, somebody walking you through it so you can learn from those questions. You have that as a great tool. You then have your software with all your questions. So there's a ton of different things you have available to help you get prepared. You've got to do cumulative reviews along the way, folks. There's too much information here. You're studying 300 hours. Chances are you're probably studying, I don't know, maybe 20 hours a week. Okay, you're studying maybe 80 hours a month. So what are you studying? About four months for this at least? And that's if you could do 20 hours a week. So you might be studying 5 or 6 months. I don't know. But look, if you study something in week 1 and you don't look at it for 4 months, out of sight, out of mind. So it is incredibly important, folks, that a third, when you're done with a third of the curriculum, before you do your next topic, do a cumulative review. You're done with 2/3 of the curriculum, do a cumulative review. You've got to leave your last 2 to 4 weeks before the exam strictly for practicing and reviewing and mastering your content. You should not be learning anything new. The last 2 to 4 weeks, you should be strictly in review mode and working your practice exams. Sam, are you still there? Is anybody there? Hello, hello. Uh-oh. Let's see.
I'm here. I'm here.
Oh, you are?
I'm here, Mr. Rolinto. I am.
All right. Are you
so
screen?
here's like, I am going to do that right now.
All right. And I see that the question here. Let me answer this question. For the cash flow, isn't the direct method applied more towards the balance? No. Both the direct and the indirect method, folks, require you to analyze both the income statement and the balance sheet. You can't get cash collected from customers unless you have your sales revenue from the income statement and your change in accounts receivable from the balance sheet. You can't find cash paid to vendors unless you have income statement information, cost of goods sold, as well as balance sheet, change in accounts payable, change in inventory. Indirect method really reconciles why is that accrual basis net income different from that operating cash flow. It shows it on the same schedule so you could quickly assess quality of earnings. The direct method is great because it's showing you the sources and uses of cash from the core business, like the cash collected from customers. That's beautiful. We want to see that going up, not going down. We also want to see what's interesting, cash paid for like marketing and advertising. You know why that's so important? If an automobile company wants to immediately boost fourth quarter profits, what do? Cut back on marketing and advertising in November and December. Even though they cut back on that, though, in the short term, yeah, you're going to have more operating cash flow and more operating income. But how are you going to sell cars in the first quarter of the next year if you cut back on those expenditures, right? So both the income statement and the balance sheet have to be analyzed to do direct or indirect method, okay? So that was the one question I saw. Hopefully that answers it for that student. And now, Sam, you take it from here, brother.
Well, thank you very much, Mr. Olinto. And just really quickly, folks, I wanted to just, first of all, thank you very much for attending and giving up some of your evening on this. And I hope that this was enlightening. If you like what you saw from Pete, and I can't see why you wouldn't, there's a whole lot more content that we offer on this. So first of all, there is an offer for you. If you act by next Tuesday, then we will give 25% off the price of any of the 2024 packages. So we still have the August and the November administrations of the Level I exam that are good to go. And the discount code is shown right there. You can also scan that with the QR. Also, just to let you know that there is going to be a video of this that will be made available to you. All of you, when you signed on, you gave us your emails, so we will be able to give you the link to access this. I'm not sure how long the video will be up, but it will be for a long enough period of time that you'll be able to go back several times if you want and go through it, review it. And of course, if you have any questions that arose after that or after this from tonight, then by all means reach out to us and we will get back to you with an answer. So I think that's going to do it for UWorld tonight. And again, once more, I thank everyone who attended and thank all the people on our side, Chad, Madeline, Rachel, and of course, our very, very skillful lecturer, Mr. Peter Olinto. So I wish everyone a good evening and hope to see and hear from you soon. Thanks again.
We won't let you down. We love what we do. I promise you, no one's going to work harder to help you pass than the folks here at UWorld. From all of us, again, thank you so much. Appreciate your time and attention. Sam and the rest of the team, thank you, and good luck studying. And I will see you in Level 1. Let's go.
Let's go. Thanks so much, folks. Have a good night.
You too. Bye-bye.